All right, let's talk about the impact of inflation. Now, with inflation figures climbing in Nigeria, what kind of terrain are investment managers facing? Let's look at the example. So there's headline inflation at 16.47%. As of the last auction, Treasury bill auction, we're at 4% on a 364-day Treasury bill. So therefore, your real rate of return, if you subtract headline inflation from that interest earned on a 364 bill, you get a real rate of return of negative 12.47%. So how do investment managers get past that? Joining me to discuss is Babajide Atolagbe, Investment Risk Analyst with Afrinvest Asset Management Limited. Babajide, thank you so much for joining us. Good afternoon to you.
Thank you.
So,
good afternoon.
How would you describe the terrain for investment managers in 2021?
So I think that the investment terrain for 2021 would be a complex one for investment managers. And why have I said this? The pandemic has actually reshaped the dynamics surrounding the investment environment in 2021. And, taking a clue at what we saw in 2020, we're able to highlight two major factors that we think will shape out how investment managers will play in 2021. The first is the fact that we have a very, very high-risk environment. Risk levels are currently elevated. And, the COVID-19 pandemic has actually exposed, businesses, countries, and individuals to a number of risks. We're talking about macroeconomic risk, we're talking about business risk, investment risk, and, among many others. So we have an environment whereby risk levels are actually very, very high. And on the other hand, the second factor is that we are currently in a low interest rate regime. Looking at what happened in 2020, in the bid to support the economy, we saw that central banks across the world actually cut interest low to all-time lows in the bid to stimulate the economy, like I said earlier. So that has given us this low interest rate regime, and this is actually, globally. For Nigeria here, what we have here is a reflection of what's happening at the global stage. The Apex Bank actually cut benchmark rate in order to support the economy, and also forced rate in the secondary market to record low levels. And this has actually compounded the problem investment managers currently have. On one hand, you have elevated risk because for heavy investment you want to partake in 2021, aside from doing all your risk factor, you also need to do a COVID-19 risk adjustment because you need to put the factor that into your considerations. And on the other hand, if you look at the returns in terms of yield, they are actually very, very low. And we have this position whereby investment managers are exposed to a high number of risk, and interest rate levels are actually low, and this seems to be no sort of compensation for in terms of risk-free assets.
Thank you so much for that. So, and well explained. Elevated risk, COVID-19 risk adjustment, a lot of factors to take into account. So, how do you navigate your way past that real rates of return dilemma that we put up on our screen just a moment ago?
So I think for investment managers, if you actually want to beat the real return we see, you need to optimize your portfolio in the sense that your diversification must the way you diversify your assets and your funds must actually be efficient in the sense that you have to allocate your funds to areas where you feel that you generate a higher return. And meanwhile, while you're doing this, investment managers and basically investors need to be conscious of risk factors because you don't want to expose yourself to a number of risks simply because you want to generate a higher returns. What we have now is that investment managers have to keep on deploying assets strategically. You need to be very careful of how you deploy cash. And and also you have to put your ears out there to see what monetary authorities and policymakers are saying, because they actually play a big factor in how the investment environment is going to be going forward.
Thank you for that. So, we've been talking about inflation all morning. Looking at those latest inflation figures out this morning, if those figures continue to rise, does that obviously make things more complicated amidst everything else that you've mentioned? Okay, so I hope you caught the question. As I said, I was looking at these inflation figures now. If those figures continue to rise, does that obviously make things more complicated for investment managers?
Absolutely. Absolutely, it does make things more complicated for investment managers because you are currently in an environment whereby the real return is actually negative. And that simply means that, there's basically no compensation for saving or compensation for investing. So you can also interpret it in a different way that investment managers, or let me say investors, will feel that it's better I spend my money than actually saving my money for a short period, because over the time you continue to see that inflation continues to eat your value for money. Also, aside from inflation, we also have other factors that are also pressuring investment returns, and that's the currency risk, which is the currency devaluation we've seen a number of times in the last 12 months. So all of these factors put together are kind of like a disincentive for investment managers going forward.
Indeed, I think the I&E window closed at 409 or 410 yesterday. So look, the low yield environment you mentioned, if we look at investor expectations, right? Are investment managers under pressure to deliver returns to investors in this low yield environment that you've described?
Yes, I feel the pressure is there, because if you look at what happened in 2020, I like to reflect back to 2020. Market actually rallied, and prices were positive. A lot of investment houses, a lot of managed funds actually closed positive, and against that backdrop, returns were actually cool. And for investors, they're actually looking forward to another stellar performance in 2021, and some are even looking for higher return. And looking at all those factors, those are one of the factors that largely put investment managers on their toe. And also in terms of the negative return that we've seen, one of the questions that investors will ask you is, if I give you my funds, are you able to beat inflation? That's a very critical question that always comes with funds that come for management. So these factors, you see that yields are currently low. You have very, very high risk in the environment, and particularly risk-free assets, which we believe that investment managers are supposed to play more in that space. Yields are at low levels, so it seems like the pressure is actually high, and this pressure might actually push investment managers into looking at unconventional asset classes. Like what we saw in 2020, given the low yield environment we saw in the fixed income market, we saw some sort of traction in the equities market. Activities in that place actually rose significantly, and going forward, we believe that the factors, this same factor would also drive how investment managers play in the private asset classes.
Babajide, what direction do you think interest rates will take in 2021? How do you think they'll fare?
Globally, the U.S. Fed has actually, we like to track the U.S. Fed because they give pointer for the interest rate environment. But as at the beginning of 2021, the U.S. Fed actually stated that interest rate will remain low going forward, especially in the first half of the year. However, in the second half of the year, they mentioned that a number of factors will determine the direction of interest rate, and that being the unemployment numbers and inflation levels. However, for some Fed committee, they believe that interest rate is expected to remain low from now to 2023 until the effect of the pandemic actually thins out, and that's what we have at the global level. For here in Nigeria, we saw at the last MPC meeting that the apex banks actually kept all monetary parameters at par, indicating that we also have to follow what we see at the global levels. So we believe that in the short term to mid term, interest rates will remain low, and if you also look at it from another perspective, it's also good this also supports the fiscal positions of the government. So they will actually want interest rate to remain low, because that's more of like a source of cheap borrowings for the government. And in 2020 we saw how the economic went into recession. 2021 we know that the economy needs to to come out of that recession, and funds will be the major factors, aside from other factors like COVID-19 vaccines. Funds will be the major factors that will also drive Nigeria and put us above the waters. So we believe that interest rates will remain low, and it will also remain low for the next, let's say, 2 to 3 years.
Babajide Atolagbe, investment risk analyst with Afrinvest Asset Management. Thank you so much for joining us. We appreciate your insights.